Welcome back. Today, we are diving into the engine room of our economy, the capital market. Whether you're a student, a new investor, or just curious about how money moves from savings into massive projects, this guide to Unit 31 will break it all down for you. Think of the capital market as a bridge. It channels savings from people like you and me into enterprises that need funds to grow. This promotes long-term growth and makes the economy more efficient and competitive. It's essentially a market for long-term debt and equity shares. The capital market has two main branches. The primary market is where companies issue new shares or bonds to the public for the first time to raise funds. The secondary market is where those already issued securities are traded among investors, usually on a stock exchange. If the primary market is the showroom, the secondary market is the resale market. In India, the two giants are the BSE, founded in 1875, and the NSE, which started in 1992. We also have specialized exchanges like India Inc. in Gandhinagar for international services. Most of these have undergone demutualization, meaning their ownership, management, and trading rights are strictly separated for better transparency. Ever wonder where your shares actually lie? They are held in electronic form by depositories. In India, we have two, NSDL and CDSL. This system eliminates the risk of theft or forgery of physical certificates and makes trading almost instantaneous. What can you buy? First, there's equity. Ordinary shares give you ownership and voting rights. Preference shares are a bit safer, they get a fixed dividend and are paid out before ordinary shareholders if a company closes, but they usually don't give you a vote. Then there's debt. Debentures and bonds are basically loans you give to a company or government. They pay you interest, called a coupon. For the ultimate safety, there are government securities or G-Secs, which are considered credit risk-free. When a company goes public, it's an IPO. Often, they use book building. Instead of a fixed price, the company offers a price band, and investors bid. The final price, known as the cut-off price, is discovered based on that demand. Before you invest in an IPO, you must read the red herring prospectus. It doesn't have the final price yet, but it contains everything else: the company's business plan, their financial health, and most importantly, the risk factors. It tells you exactly what they plan to do with your money. Trading is fast, but settlement takes a moment. Traditionally, India used a T-Jor-2 rolling settlement. Trade on Monday, get your funds, shares on Wednesday. However, we are moving to a T-Jor-1, which means shares and money move within just 24 hours, reducing risk and increasing liquidity for everyone. Applying for an IPO? Use ASBA. Instead of sending a check, your bank just locks the money in your account. You keep earning interest on it until the shares are actually allotted to you. No more waiting for refunds if you don't get the shares. The great debate: equity or debt? Now, before you put your money to work, you need to decide, do you want to be an owner or a lender? This is the classic debate between equity and debt. Let's look at this comparison table to see which one fits your style. Feature 1, nature or returns. First up, the nature of the investment. When you buy equity, you are buying a piece of the company, you are an owner. Because of that, your returns come as dividends, which can grow as the company grows. Debt, on the other hand, is basically a loan. You are the lender, and in return, the company pays you a fixed interest or coupon. Feature 2, risk or priority. What about risk? Equity is higher risk because if the company fails, you are the last one to get paid. But with debt, it's lower risk because you have priority. If a company goes bust, debt holders are paid from the assets before the equity owners get a single rupee. Feature 3, voting or tenure. Here's where it gets interesting. Voting rights. Equity owners usually get a say in how the company is run. Debt holders, no vote. And finally, tenure. Debt has a finish line, a fixed maturity date when you get your principal back. Equity is perpetual. It stays with you as long as the company exists or until you sell it to someone else. Closing tip. So, which one is better? Well, equity builds wealth over time, while debt provides stability. Most pros don't choose just one, they build a balanced portfolio using both. Question number 1. Which market is known as the new issue market, where securities are offered to the public for the first time? Option A. Secondary market. Option B. Primary market. Option C. Auction market. Option D. Dealer market. Answer: Option B. Primary market. Question number 2. What is the process called when a stock exchange transforms from a mutually owned association to a shareholders owned company? Option A. Privatization. Option B. Corporatization. Option C. Demutualization. Option D. Listing. Answer: Option C. Demutualization. Question number 3. Which of the following is the oldest stock exchange in India, established in 1875? Option A. National Stock Exchange, NSE. Option B. Calcutta Stock Exchange, CSE. Option C. BSE Limited. Option D. Metropolitan Stock Exchange. Answer: Option C. BSE Limited. Question number 4. In a NSDL Demat account, the account number starts with which two alphanumeric digits? Option A. AD. Option B. IN. Option C. IS. Option D. DP. Answer: B. Question number 8. Which type of preference shares allow the dividend to accumulate if it remains unpaid in a particular year? Option A. Participating preference shares. Option B. Convertible preference shares. Option C. Cumulative preference shares. Option D. Redeemable preference shares. Answer: Option C. Cumulative preference shares.